Every long-term investor eventually faces this decision. Do you go all in on stocks with something like XEQT? Or do you play it a little bit safer with a balanced portfolio like VGRO? It's a deceptively, really simple question, but it shapes everything. Your returns, your stress levels, your reaction to market drops, as well as how likely you are to stay invested for decades. Today, I'm gonna make this decision a little bit clearer. By the end of this video, you'll know exactly whether 100% equity ETF or an 80-20 portfolio actually fits you. Not someone else's risk tolerance, not Reddit's opinion, not a random YouTuber's portfolio, but your goals, your psychology, your future. So let's break it all down. You're here because you care about long-term investing. You want a simple, hands-off ETF that you can buy, hold, and let compound for years and years without constantly tinkering with it. And that brings you to these two giants, XEQT in one corner, the all-equity high-growth choice, and VGRO, the growth ETF with built-in stability. Both are absolutely excellent, both are very simple, and both are made for Canadian investors. But they deliver very different emotional experiences. And that's the part that very few people talk about, even though it's the biggest factor in whether your strategy succeeds. So today, I'm not just comparing ETFs, I'm comparing the lifestyle and mindset that comes with each one. Now let's look at XEQT. XEQT is an all-equity ETF, which means that you're 100% in stocks, with absolutely no bonds, full exposure to global markets, maximum long-term growth potential, and maximum short-term volatility and pain. XEQT follows a philosophy built on long-term returns above everything else. If you can handle the roller coaster, XEQT is designed to reward you with stronger compounding over decades. But the key question is, can you handle the roller coaster? And we'll get to that. Let's look at VGRO now. VGRO is an 80-20 portfolio. 80% stocks, 20% bonds. That 20% doesn't sound like much, but in investing terms, it changes the entire experience. Bonds are there to smooth volatility, soften crashes, and help your portfolio recover faster, in turn making the emotional side of investing a little bit easier. VGRO is built for investors who want growth, absolutely, who doesn't, but don't want to constantly sweat through every market downturn and correction. It's essentially growth with shock absorbers. Now imagine two investors. Let's call them Alex and Jordan. Alex with XEQT and Jordan with VGRO. The market drops 25%. It's very much possible. Alex sees their portfolio fall very sharply. It stings, it hurts, it feels aggressive, it makes you question everything. Jordan, holding VGRO, sees a smaller drop. The bonds steady the fall. It's not fun, you're still down, but it's a little bit more manageable. Now imagine that same situation lasting not just a couple days, but 8 months. Alex needs stronger emotional discipline. Jordan has a smoother ride. And this is why choosing between XEQT and VGRO has almost nothing to do with spreadsheet, and everything to do with how you react in uncomfortable moments. But let's look at the numbers as well. Spreadsheets still matter. Here's a trade-off. XEQT offers higher long-term return potential, as I mentioned, but with higher volatility, larger drawdowns during crashes, and faster growth during strong markets. VGRO, on the other hand, delivers slightly lower long-term returns, okay, but you also experience lower volatility, smaller drawdowns, and more stability during downturns. Markets reward risk over time. But markets also punish investors who panic. Your returns depend more on your behavior than on the ETF itself. XEQT wins the math over the years. VGRO wins the psychology. You need to know which side you fall on and what helps you sleep at night. Anyways, let's look at the fees now. So both ETFs are pretty low cost. XEQT charges around 0.2%, while VGRO charges around 0.24%. Both are very cheap. The difference isn't life-changing. Your risk tolerance matters far more than the fee difference here. I would also like to look at the way they're diversified. XEQT spreads investments across global stock markets. VGRO spreads across global bonds and stocks. So both are very, very diversified, but they behave slightly differently. XEQT, as I mentioned, gives you more growth potential, but more swings, while VGRO gives you less growth but steadier and smoother performance. Ideally, think of XEQT as a speedboat and VGRO as a cruise ship. One is a lot faster but a lot choppier. The other is considerably slower but calmer. So, who should choose XEQT? XEQT is ideal for investors with a long time horizon of 15 years or more, and those who won't panic during market drops, even if your portfolio is all of a sudden down 20%. It's also for people who want the highest returns and don't mind deep but temporary volatility, and who are comfortable seeing big fluctuations in the portfolio value. If volatility doesn't break your discipline, XEQT rewards your patience. If you sell too early, you lose. What about VGRO? I would say VGRO is perfect for investors who want a smoother, more comfortable and stable ride, but those who still want strong growth without extreme volatility, who have a medium to long time horizon and who know that they might panic during the big drops and sell everything, as well as those who prefer consistency over maximum returns. If comfort and stability help you stay invested and sleep at night, VGRO is the better long-term match. The real question is, which one will you stick with? This is the part most people ignore for some reason. Your ETF, at the end of the day, doesn't matter nearly as much as your ability to stay invested in it. If you abandon XEQT when it's down 10% in a month during a crash, then a high-growth ETF wasn't the right choice for you, and your risk tolerance is way lower. And if you stay calm with VGRO while still growing steadily, you'll end up wealthier than the person who should have stayed invested in XEQT but bailed at the worst moment once the market tanked. The ETF that fits your personality will always be the ETF that looks best on paper. Choose the one that matches your temperament, not your ego, and helps you sleep at night. So, to summarize, XEQT and VGRO are both absolutely fantastic, simple, long-term ETF solutions for Canadian investors. XEQT gives you pure growth and higher potential rewards for those who can emotionally handle volatility. VGRO, on the other hand, gives you growth with a smoother ride, but lower returns, making it easier to stay invested through tough periods that derail most people investing purely in stocks. And really, there is no wrong choice. Only the wrong choice for you. So keep that in mind. Anyways, guys, thank you for watching. If you made it this far, you're already ahead of most investors who never take time to understand their own risk tolerance. Trust me, I was one of them. And if you enjoyed this breakdown, hit the subscribe button as well as the like button. It tells YouTube my videos are at least halfway watchable. And honestly, that's all I'm aiming for. Thank you. And as always, this is not a financial advice. I'm here to give information and my personal opinion, not tell you what to buy. Anyways, I'll see you in the next one. Take care.